This is Rob Barnett. I'd like to welcome you to today's BI Energy Exchange, where we talk about our research and the latest developments in energy markets. Today on the call, we've got Salih Yilmaz joining us here live in London from normally in Dubai. We've got Patricio Alvarez over my shoulder here. Will Hares, who normally joins, had a conflict, couldn't be two places at once, so he's not with us today. We've also got Fernando Valle joining from New York, and we have a guest speaker this time who will be joining in any moment here, our colleague Rob DeBuff from the ESG team. He's going to help us unpack the recent news about Aramco CEO Ayman Nasser's appointment to be on the board of Blackrock. So we'll have a lot of fun with that topic here in a few moments. But first today, I wanted to remind everyone on the call of our React product. This is basically the first version of history. Right after our colleagues over at BN break the news on some topic, we try to come along in very short order and tell our clients what we think it all means. In some sense, this is the emergency room of analysis. Yesterday, my colleague Alessio and I put out a react on Wacker Chemie. If you don't know them, they're a German specialty chemicals company that happens to produce polysilicon. That's a key ingredient for the solar business. And they reduced their EBITDA guidance for the full year. Now, I'd like to think if you'd been paying attention to us, you probably were not shocked. After all, polysilicon prices are down about 80% over the last 12 months. And the long and short of it is that further revisions could be coming for margin and profitability if commodity prices continue to ease. And I think there's also read across for OCI in South Korea, REC Silicon, and others in the space. So I would encourage you to take a look at our reacts, look at our research, and let us know what you think. And along that same vein, I want to come first over to Patricio this week, who had a react this morning on a different commodity related more to natural gas and national grid. So Patricio, tell us what happened and what your react was about.
Sure. So the react today was about National Grid, which is one of Europe's largest network operators, just behind EDF and its largest distribution network in France. And National Grid is the largest operator in the UK, and it also has presence in the US. So this company has been under a strategic review, or let's say undergoing a strategic recalibration of its portfolio to increase its exposure to the electrification trend. So mainly this company wants to operate power assets and cut its exposure to any gas assets. So this morning, there was news that Macquarie Investment Group, which already acquired 60% of National Grid's gas portfolio, decided to exercise an option to acquire an additional 20%. Within similar terms to the original transaction, which we saw as a positive, meaning that the transaction is likely to be accretive, and it also reinforces or aligns well with the company's realignment of its portfolio. And we also expect Macquarie, the same consortium to perhaps exercise the second tranche of the option, which means that they could acquire the remaining 20% stake from National Grid in 2024, which we think is it's notable considering that it has been one of the slowest, one of the weakest years in terms of deal activity in the utility space in Europe. So it's sort of a win-win we see for both parties. And at this pace, we expect National Grid to be fully aligned to electricity, having only power assets, interconnectors, and distribution and transmission assets, only power from 2024 onwards.
Okay, very interesting. Thank you, Patricio. I think we want to move to another commodity next, CO2 in this case. Fernando, you had a really interesting note out the other day called Exxon doubles down on carbon capture strategy with Denbury deal. Tell us about what Exxon did there and what your take on it all is.
Yeah, absolutely. So Exxon is acquiring Denbury for $4.9 billion, all equity deal. Denbury used to be a pure E&P, but lately they progressed to being carbon capture as well as an E&P. They do EOR, enhanced oil recovery. So essentially they capture carbon and then they inject the CO2 under the oil-water contact to push more oil out of the wells. Something that Occidental does very well in the Permian. Kinder Morgan has a CO2 business as well. It's a fairly well-known tactic for depending on the oil field. What was really interesting about this deal is that Exxon has really moved towards carbon capture. They, if you go 5 years back, they had two ways of growing in the low carbon space. The first one was algae-based fuels. They were trying to develop, pardon me, a liquid biofuel made out of algae. And then the second one was carbon capture. And at first, it seemed like algae was a little bit more advanced, and it certainly swapped places, and to the point where we think they've seized most of the work on the algae side of the equation. And it really solidifies their difference of opinion versus the Europeans, because going into carbon capture essentially means they're trying to decarbonize the existing infrastructure as opposed to building more electrification, focusing on natural gas, power generation, and traditional renewables. What made Denbury very attractive to Exxon was they have an existing CO2 pipeline that goes from Louisiana to essentially to their Houston hub, goes through several of Exxon's industrial sites and some of the partners where they're establishing hubs. So that saves them probably 3 to 5 years worth of permitting construction by having that pipeline. They can even expand it with the right of way. Obviously, it will require some more work, but it really dovetails with what they're trying to do in creating these hubs in Louisiana and in the Port Arthur region to collect CO2, and it really even adds an opportunity for them to use at the U, what we called it, in CCUS, which is the utilization, as opposed to just pure storage of CO2, because as I mentioned, Denbury already does EOR.
Fernando, I recall one of my favorite moments over the course of my career, maybe a decade and a half ago. Craig Ventnor came to CERAWeek and he said, "I'm here to kill the oil business," or something to that effect. And there were some polite chuckles in the room. And I believe he had a partnership with Exxon through synthetic genomics or something along those lines to work on those algae biofuels. Do you think that is that idea completely abandoned at this point, or is it still at some level floating around there in the background?
I think it's floating around in the background. The issue, as I understand, is the footprint to grow the algae competitively and then process the fuel. And the actual processing shouldn't be too difficult. We do a lot of in the renewable diesel space today. It's really making sure that the footprint in growing the algae can be compatible. There are some really interesting technologies in the biofuel space, from digesters to pyrolysis that can produce renewable fuels. They all still have some wood to chop, pun intended, in order to get to the full commercial scale.
Okay, I think that's a really nice segue. Rob, we've already given you an introduction, and we've just heard Fernando talking about the sort of ESG merits of Exxon's Denbury deal, and we ended up talking a little bit about algae biofuels. But we asked you specifically on this call to come on and share your thoughts, if you have any, on the appointment of CEO Ayman Nasser, the Aramco CEO, to BlackRock's board. I mean, I think BlackRock has been somewhat involved in the sort of broader ESG discussion, so we wondered if there was any kind of reading between the tea leaves that one could make based on this news this week. So I'm going to give the floor to you to give us your reaction.
Yeah, sure. I mean, in truth, I don't think adding any one specific director to a board has, will change the day-to-day operations of how BlackRock operates. But, I will say, certainly the optics send a lot. I mean, you've seen BlackRock come under fire in a number of U.S. states for quote unquote discriminating against the oil company. Now they're pushed back. Has been that BlackRock is and remains one of, if not the largest investor in hydrocarbons, both on the public equity and the private equity side, and that's throughout the value chain. I mean, obviously, some of that is just as a passive investor; they have to hold these stocks anyway, but they do offer a lot of kind of oil funds, oil infrastructure funds. So, in truth, they're really not discriminating against oil companies. But of course, when it comes to politics, facts don't always matter. So that said, there's been a lot of what we call, green hushing, where, maybe 2 years ago, they've been very aggressive about their climate ambitions or the ESG ambitions. They've, to be frank, a lot of asset managers kind of overstated their ambitions, and now that's come back to bite them now that the political winds have shifted a bit. So now they're going about kind of underselling their ESG criteria. Now, in almost all cases, they're actually not changing their investment philosophies. They're still kind of laser focused on the carbon transition and how to manage their portfolios throughout that. But it really is just about maybe projecting this image that hey, we're not just a bunch of tree huggers, we do care about business. So this, I see this as kind of the next evolution of almost beyond green hushing to, I don't know if you want to call it blackwashing or maybe oil painting. Oil painting would be a good examination of that, just showing that hey, we do still see the oil ecosystem, the hydrocarbon ecosystem, as part of the broader carbon transition for many years to come, and we're not moving away from that.
I love the idea, oil washing. Now, if I remember
Oil
history
painting,
correctly, oil painting. If I remember history correctly, BlackRock supported engine number one in some of the changes that they were pushing for on Exxon's board and strategy recently. Any sense if this ties into any of that, and could BlackRock maybe change some of its thinking around how they might vote on activist type issues like that?
Yeah, no, I mean, I remember saying at the time, I mean, Exxon came down and everyone said, all right, what's next? Who's going to be hit next? Is it going to be BP? Is it going to be Chevron? But, if you think back then, Exxon was really in a unique position where they were kind of a laggard. They were seen as a laggard. I mean, I used to be an oil and gas analyst. I remember, this was back in the Rex Tillerson days. He was rarely even on the earnings call. He was, they're just not necessarily known for being responsive to shareholders. I think BlackRock for a number of years had been pushing all the oil companies to, start at least thinking about strategizing for the carbon transition. Many oil companies, you see BP, I feel like continues to try and sell themselves as beyond petroleum or whatever it is. Chevron has done a lot in terms of renewable fuels and things like that. Exxon really was kind of, their solution was really algae. Coming up with algae, which they weren't putting a lot of money behind it. It was never very promising. So the fact that that was kind of it, and they were kind of being obstinate, at least in the eyes of many investors, I think that's ultimately why you did see the engine number one situation come out. It wasn't kind of the start of a trend. I think it really was just a perfect storm and more of a one-off, if you ask me. And I don't think you would expect that. I mean, certainly it sent a nice warning signal to the rest of the industry that, hey, if you don't start incorporating these issues, there are repercussions to that. But I don't think, I don't see BlackRock. I never thought BlackRock was kind of taking names and coming for everyone's job, nor do I think their philosophy, the overall philosophy has changed. I mean, something else we've looked at, not just in activism, but looking at the last proxy season, we're recapping this now, but we've talked about how you're starting to see support. You saw a bit of it last year, and you saw even more this year. Support for a lot of these shareholder proposals around climate change has dwindled considerably. Now, in many cases, BlackRock never supported them, but in some cases where they were a little more supportive in years past, they were not. However, I would caution that a lot of that has less to do with the headline numbers and more if there's a bit more drilling down that needs to be done. So for example, there was a resolution at Chevron last year, basically to set short and medium and long-term targets of scope 1, 2, and 3 emissions. That didn't pass, but it got something like 30%. This year, the very similar proposal, except it's specified only medium-term scope 3 targets. That got less than 10% support. Many critics of ESG were quick to point out that, hey, support went from 30% to less than 10%. But if you actually look at the proposal, it's quite different. It was a bit more aggressive this time around, and we saw that a lot. So the SEC, at least in the States, has changed the way that what they are willing to accept from a shareholder proposal. There are certain rules around making a shareholder proposal. It can't, you can't say, hey, we want you to release, you can't go to Levi's and say, we want you to release jeans in purple, right? Like that's day-to-day operations. So, the SEC kind of has moved from the Trump administration to the Biden administration on what they consider meddling in day-to-day operations. The Biden administration has been very clear, the SEC, that setting greenhouse gas emissions targets is not meddling in day-to-day business. That's a bigger long-term strategic issue that kind of impacts all corporations. Therefore, it is worthy of a shareholder proposal. But because of that, we've really seen the floodgates open in terms of these shareholder proposals. They've become increasingly more aggressive. BlackRock has been less and less willing to support these proposals. So therefore, the natural trend is to see BlackRock support of quote unquote environmental proposals has faded. But again, reading between the lines, I don't think BlackRock's position has changed at all. It's just, the votes, the ballot box has changed, if that makes sense.
Okay, very interesting. I'm waiting for my purple jeans from Levi's. Salih, I want to come to you. You cover Aramco. Any sense on the type of person that Ayman Nasser is? What is his view on some of these broader strategic ESG type questions that Rob was just talking about? Does Aramco even put out an ESG or sustainability report?
They do now way more than before, but I think there have been a couple of instances where Ayman Nasser pointed out that we may be doing ESG not the right way, and we need to perhaps rethink the way we're handling the climate situation. But in terms of why Aramco, perhaps for BlackRock, and why they may have chosen Ayman Nasser, in terms of oil expertise, if that's what they wanted on the board, it is probably a good choice. Looking at Aramco, it is the largest oil company in the world. It is responsible for the totality of Saudi Arabia's production, which is about 10% of global oil production. A little bit less now because obviously Saudi Arabia and Saudi Aramco has to comply with OPEC Plus strategy, and currently they are doing quite a bit of output cuts to keep the oil market in balance. But looking at Aramco, this is a company produces a lot, but also has customers all around the world. So it really does have its finger on the pulse in terms of what's happening on the demand side as well. And they have 10% market share in the world, and this will probably grow. When we look beyond this decade, and when we look at what the other global majors are doing, we're seeing investment in the legacy oil and gas business falling, partly because of shareholder pressure and partly because majority of their peers are actually earmarking more and more capital into low carbon businesses, whereas Aramco is actually doubling down on its legacy business. I mean, it is, and this is probably also why Nasser is a good choice, is they are investing more in the fossil fuels business, but they do have room to be investing in new businesses as well, and they've been quite vocal about earmarking more capital into hydrogen, which they could be a global leader in. I think being in the Middle Eastern region, I think they have a lot of potential in renewables as well, which they may be doing more of in the future. So I think when you think about the oil business, but also a company that is just so lucrative that they're investing back into their fossil fuel business, but into the new businesses as well, and that has a lot of idea on where the demand might be heading, at least in the short term. I think Aramco is. I mean, if you're looking for for that type of expertise, and if you're also looking for a little bit of a Middle Eastern expertise, Aramco is probably a good choice. And I will also add, given Aramco's acquisition of about 70% stake in SABIC, which is a petrochemicals producer, which is growing in importance, and I mean, SABIC is the Aramco of the petrochemicals business. So it is a very important player in that sector as well. And I think, I mean, thinking about petrochemicals, plastics, obviously a very important part of the climate discussion. So I mean, generally, I think as Rob summarized quite well, I think this is BlackRock's way of showing commitment to the oil space. I mean, it's just showing that they're not going to be actively divesting, I suppose, anytime soon. And yeah, I mean, the whole thing I think is just quite interesting, given asset managers are just trying to find their position and their role in ESG investing.
And I think also BlackRock's not just their their public equity and ETF businesses, but also some of their infrastructure capital as well. You've heard there was a story I think last week about how an Aramco bond got that was sold to BlackRock, qualified as for an ESG fund, just because it was, since it was a pipeline, since it was specific to the pipeline business, not the oil business, it somehow snuck into one of the indexes and got marketed into a green, I don't know, not a green bond, but a green ESG bond fund that was managed by BlackRock. So, I mean, certainly BlackRock is a big investor on some of these projects as well. What was that?
Must have been on the governance side.
Yeah, exactly.
Or maybe the social.
Yeah.
And the score is high on those fronts.
Yeah, well, I mean, again, a pipeline itself has very little environmental.
Right, I'm saying it must have scored high on the S and the G then.
Yeah. Who knows how some of these indexes are built, but yeah, I would say. I mean, and the other thing, even on the climate side, I mean, Aramco has very low emissions relative to many of the global peers out there. Its emissions intensity, so you can almost see that in a world where if oil demand dwindles and favors the lower carbon intensive producers, then certainly Aramco would be a winner in that scenario.
Yeah, this is one thing that they've been arguing, that I mean, in absolute terms, I mean, of course, they're producing a lot, so that's a big number, but in terms of intensity, it is actually much better than most of their peers. So.
Yeah, and if you think about things like carbon adjustment taxes, I mean, that probably helps the Saudis and hurts some of the other coal-dependent economies like China, for example. So that I could certainly see the Saudis being almost in favor of that kind of pricing mechanism.
Speaking of pricing, I don't want to completely table ESG. I have another fun ESG thing to come back around on, but this is the first call we've done in a little while where Brent has been over $80 a barrel. I guess I'm a little surprised because some of the more macroeconomic indicators don't necessarily seem to be pointing you in that direction. So I want to come to Fernando first. Let's get your pulse on the oil market. Why are we suddenly, or maybe not suddenly, but for the first time over 80, at least on a Wednesday in a little while. So what's going on in the market?
I think this just solidifies our view that it's all about interest rates and interest rate expectations. As you said, the macro indicators have been dismal, if anything. You look at China, for example, the second quarter GDP was a whole percentage point below expectations, 6.3. If you adjust for inflation, it was actually below the first quarter, so it decelerated and showing even worsening numbers in June. So by all means, a very, very poor result. But I think what's driven part of this rally is we look at U.S. CPI at a 3% print, and we're like, well, all right, it's time for the Fed to stop hiking rates and maybe even cut some rates so we can stimulate the economy. You know, we conquered inflation, we're close enough to 2%. Now we can go back. But of course, that is, it's almost, if you are expecting that oil prices can go higher because inflation is lower, of course, that will just reverberate in inflation later. And the sticky part of inflation is not settled yet, which is where the Fed really looks. So we don't think we're over the interest rate cycle. We think oil still, from a demand standpoint, doesn't look very healthy. But you know, when we look further out into 2024, 2025, the supply side of the equation will be the driving factor. But in the short term, it's really all about demand. We're waiting on the EIA in the next couple of minutes, and so far the demand numbers look very, very poor, and we wouldn't expect this rally to be very long-lived or have a lot of strength beyond where we are today.
Salih, I want to get your read. Do you got a similar view as Fernando, and how's what's going on with OPEC playing into all this?
Yeah, I mean, not too much to add. I mean, it's really been a tug of war between kind of potential physical tightness in the market and macro, and some of the data from China also has still been showing that the economy is stuttering there. The recovery is really stuttering there. But on the physical market side, I mean, we are seeing some more signs of potential tightness as we look at the second half of the year. We are seeing that some of the Russian oil shipments are falling as expected, and it's going to be in August where they're supposed to be delivering that 500,000 barrels per day of cut in exports. Inventories seem to be falling. I mean, we'll get the more details on the API data today, but it looks like in the U.S. Inventories seem to be falling. And I mean, as Fernando said, I mean, some signs that maybe Fed may be close to concluding its the cycle of rate hikes. But again, I think the market is watching the China data very closely, and you know, the recession worries that we've been talking about for a while, especially for the U.S. and the Eurozone, I mean, is still very much there and is a big overhang. So I think the same moving parts, but yeah, I mean, I think we continue to believe, at least in the physical market side, if OPEC delivers the cuts that they promise, which we think for the most part they will, and even if the demand hike, especially from China, is not as big as we and IEA and OPEC once thought, even if it's a little lower than that, it looks like it would still be a pretty tight market. So I wouldn't be surprised if we remain still range bound, but maybe a tighter range between $80 and $90 a barrel.
Patricio, I want to swing around to you, get a quick check-in on the European gas market. Has the big decrease in prices helped us get inflation more in check in the region?
Yeah, I think that's one of the signals, and perhaps one of the contributing factors has been a very sharp decline in gas prices year to date. Once again, TTF is trending below 30 euros per megawatt. It's at around 27 at the moment, which is not far from its long-term sort of average of about 20 euros per megawatt. So we're somehow approaching normality, at least at the moment. And yeah, I think that corresponds sort of to a combination of two things. On the demand side, this is a seasonally weaker period. It's a shoulder season before we start the heating season in November. Gas storage levels seem very healthy, at about 15% above their sort of long-term norm, and significantly higher at where they were at this time last year. It seems like yeah, there's very little risk in terms of supply risks or our ability to meet short-term demand. But what we do have to note, and I think the IEA reiterated this on the report yesterday as well, that entering the heating season, there are a couple of risks, especially a combination of colder than average weather, which is something that we cannot first forecast at all. But the thing is that the supply situation could worsen if Russia decides to cut supplies via the two remaining pipelines. But all that said, I think it's very unlikely that there will be meaningful stress during this year, but perhaps a combination of these supply risks materializing would lead to lower storage levels by the end of next winter, which means that we still may see some volatility in pricing, but nothing close to what we saw last year.
Okay, cool. So there you have it. Interesting view on oil and gas. Okay, so I mentioned we'd come back to one last ESG topic with the few remaining minutes, and I didn't prep the team in advance, so I don't know if everyone's seen it, but Exxon has a commercial out that's sort of being billed as an anti-EV commercial. It shows a bunch of people in a city with all of these cables, and then it sort of cuts to a scene of a lady driving out in her ICE automobile in the countryside, out communing with nature. And so very interesting. I think it's pretty effective, pretty good commercial. And so Rob, I want to come to you first. Does it make sense for an oil company to really be weighing into the sort of debate around EVs versus ICE automobiles? How's the ESG community going to react to this kind of stuff coming out from a company like Exxon?
Well, again, I think it has more to do with kind of the optics than anything. Certainly the ESG community does not look particularly favorably upon Exxon. See that engine number one discussion earlier. I feel like it's funny they've tried for years to kind of say like, oh, lighter, plastics for lighter tires and algae and fuel. So they've tried to always greenwash. So for them to kind of push back against EVs, I think, they can try to push against the trend. I think that the trend is there. I mean, certainly government policy is very supportive of the EV transition. I mean, obviously, I think some of the fears are about, range and things like that. So maybe kind of playing into that a little bit, playing into those fears wouldn't be completely off-brand for Exxon. That said, if, I do think if, there's certainly a spot for, the natural gas space, for example, in the EV ecosystem, and gas-fired power plants, and that ultimately leading to charging of EVs. So I do think electrification isn't necessarily universally bad for Exxon, but I can definitely see why they would want to kind of keep the lights on for ICE vehicles.
Okay, very cool. Fernando, we'll come to you next. What do you make of the idea?
I mean, nothing that I would think myself. I'm not a huge believer in EVs, just as they currently stand, not just range, but also battery reliability. This little thing here gives me trouble. It's plugged in right now all the time, and their battery failure rates are high. And we're seeing some issues with other energy policies. I was just reading about Germany today, and their CO2 per kilowatt is down, but so is their overall energy demand. And I think it was interesting, you had Patricio of Total Energies speaking about in the current scenario for energy transition, it necessarily goes through a reduction in energy demand overall because the price becomes too expensive. And again, I think the biggest difference between me and some of the EV adapters is I come from a poor country that still needs to increase how much they consume, how much energy they consume. And so I don't think cutting energy consumption is an acceptable solution.
Salih, as someone based in the Middle East, what's the conversation about EVs there these days?
Yeah, I mean, you don't really see. I mean, I'm in London at the moment, and you do see quite a few. You don't see as many in the Middle East, at least just yet. And again, I don't really know what to add on the commercial, but just in general, obviously, road transport is a big part of oil demand, and oil demand doing well, oil demand going up is generally good for the sector, and it's generally good for prices. And I mean, I suppose the idea that, at one point, it could be just EVs in the roads and we lose all that road transport fuel demand. I don't think this is happening anytime soon, but this is obviously not a great thing for an oil company. So I suppose that might be also where they're coming from.
Patricio, we're going to give you the last word, but I'm curious, are any of the electric utilities you cover running pro EV ads?
No, not at the moment. I think a few of our utilities are sort of retesting the waters in terms of going into EV charging, which is an endeavor they took on a couple of years ago that didn't go too well. A few of the oil majors, I believe Shell did the same as well here in the UK and a few countries in Europe. And again, the problem there was regulation. The demand for charging, for EV charging, wasn't there, and if utilities don't get any sense of something similar to a regulated return, they really can't afford to put their capital in there. But on that note, maybe not on EV, but electric utilities are now more than ever talking about decentralized energy efficiency, and sort of trying to hammer down on those energy bills and increase the penetration of renewables. I think the message is still very clear, pretty much clear for European utilities, that electrification and the cleaner the better is the way.
Okay, thank you very much, Patricio. I really want to thank our colleague, Rob DeBoff, for joining us. We have an entire ESG team. If you want to know kind of more about their franchise, some of the data and research they're writing, you can run BI space ESG. Go take a look at what Rob and some of his colleagues are up to. Very cool stuff. We hold these calls on the first and third Wednesday of every month. We hope you'll join our next one, which will be August 2nd, and look forward to being in touch. Thank you for your time today.